Imagine this. Two friends graduate from college in the same year. Alex becomes a software developer. Ryan starts working in sales. Both earn around $75,000 a year. They rent similar apartments, drive similar cars, and have almost identical lifestyles. 10 years later, Alex has over $600,000 invested. Ryan owes nearly $38,000 in credit card debt. How is that possible? They earned almost the same income. They lived in the same city. They had the same opportunities. So what changed? It wasn't their salary. It wasn't luck. It wasn't intelligence. It was a small piece of plastic that millions of Americans use every single day. A credit card. Credit cards aren't evil. In fact, when used correctly, they can offer convenience, fraud protection, and rewards. But the system isn't designed to make you wealthy. It's designed to make money for the companies that issue the cards. And today, we're going to uncover how that system works, why so many people fall into the credit card trap, and how you can avoid becoming another statistic. Every time you swipe your credit card, someone gets paid. The coffee shop pays a processing fee. The payment network earns a small percentage. The bank earns money. Most people think banks make most of their money from annual fees. That's only part of the story. The real profits often come from people who carry a balance and pay interest over time. If a customer pays their statement balance in full every month, they may pay little or no interest. But if they carry a balance, interest charges can grow month after month. That's where the business becomes highly profitable. The surprising part? Many people don't expect to carry debt when they first get a credit card. It usually starts with something much smaller. Imagine your refrigerator suddenly stops working. Replacing it costs $1,400. You don't have enough cash saved. Your credit card makes the problem disappear instantly. At least, that's what it feels like. Instead of seeing money leave your bank account, you simply tap a card. The purchase takes seconds. The bill comes weeks later. Psychologists have found that people often experience less immediate payment pain when using cards instead of cash, which can make spending feel easier. That tiny delay changes the way many people think about spending. And that's where the trap quietly begins. A few weeks later, your statement arrives. Balance $400. Minimum payment $35. Your brain immediately thinks, only $35? That sounds manageable. So you pay the minimum. Next month, interest is added. Your balance barely moves. You pay another minimum payment. Months turn into years. Many people eventually pay far more than the original purchase price because interest keeps accumulating while the balance remains. The refrigerator is long gone, but the payments continue. Now imagine you get a raise. Instead of saving more, you upgrade your phone, then your furniture, then your vacation. Individually, each purchase seems affordable, especially because the monthly payments look small. Soon, several monthly payments begin stacking on top of each other. The total becomes much harder to manage than any single purchase. Banks advertise cashback, travel points, airport lounges, sign-up bonuses. These benefits can be valuable, but only if you avoid paying interest. If someone earns $200 in rewards, but pays $800 in interest, they're not winning, they're losing. Rewards are helpful when used responsibly, not as a reason to spend more than you otherwise would. Here's how it often happens. A medical bill, a car repair, holiday shopping, a vacation, unexpected expenses. None of them seem catastrophic alone, but together, balances grow, interest grows, minimum payments grow. Eventually, a large part of each paycheck is already committed before the month even begins. Not because of luxury, because of yesterday's spending. Credit cards themselves aren't the enemy. Poor habits are. Some practical habits include: only spend money you already have available. Pay the full statement balance whenever possible. Build an emergency fund so unexpected expenses don't automatically become debt. Don't chase rewards by buying things you didn't already plan to purchase. Review every monthly statement carefully. A credit card should be a payment tool, not a long-term loan for everyday spending. The biggest danger of credit cards isn't the plastic. It's the illusion they create. They make tomorrow's money feel available today. For many people, that convenience slowly turns into dependence, and dependence can become expensive. The people who build wealth aren't necessarily those with the highest income. They're often the people who learn to control their spending, avoid unnecessary interest, and let their money work for them instead of against them. The next time you pull a credit card out of your wallet, ask yourself one question. Am I buying this with today's money or tomorrow's? That single question could save you thousands of dollars over your lifetime. If you enjoyed this video, subscribe for more breakdowns on money, investing, and the hidden financial systems that shape everyday life.